Social Finance Inc., or SoFi Technologies Inc., Nasdaq SoFi, is a one-stop-shop financial platform that primarily engages in banking, lending, debt consolidation, including student loans, and operating a brokerage. It also operates Galileo Financial Technologies, a fintech company operating primarily in the B2B space, while SoFi operates primarily in the B2C space. Its stock has had a wild ride, coming to market in a SPAC deal in 2021 instead of a traditional IPO. SoFi Fundamentals revenue has been increasing over the past few years, but despite this, net income is almost flat from launch to now. It may ease some investors to see that gross margins have been consistently increasingly since they have gone public, indicating that despite net income stagnation, they are becoming better able to monetize their products and services. This is partly because of the volume effect, economies of scale. As SoFi builds a larger customer base, fixed costs like data infrastructure and licensure for services in as many jurisdictions as it serves are costly, don't impact margins as much. Dynamic costs, which remain low per individual user for financial institutions, allow for better margins. Lo and behold, SoFi's members and products have been consistently growing over the last year. This increase in profitability has enabled SoFi to raise its EPS to a positive for the first time in the first quarter of 2024 and maintain it through the second. Their free cash flow position is improving, albeit still negative. This is a positive sign, but not a positive metric for SoFi. This is a big issue, as many investors, like myself, do not invest in unprofitable companies on principle. Now let's address the elephant in the room, the PE ratio. SoFi is traditionally valued more like a technology company than a financial company, and its forward PE is insanely inflated compared to its peers. That being said, it's on the downtrend, as is at its lowest in a year. It may be justified, and I believe that SoFi has one thing that investors love: a narrative and a good story. The SoFi narrative is popular with millennials. The company is headed by Anthony Noto as CEO, who helped secure the rights to the naming of the new stadium built in Los Angeles, Inglewood for locals, to host both of its NFL teams, the Chargers and Rams. Noto has ties to a lot of places. He was CFO of the NFL, COO at Twitter under Jack Dorsey, and head of Twitter Ventures. Noto has established a narrative that SoFi is an innovative tech company out to change the world and make it a better place. The narrative really sells. This appeals to SoFi's core demographic, millennials, who see big banks and institutions as untrustworthy, GFC trauma, but use their products increasingly more than other generations. Millennials care deeply about the missions of the companies they use, and Noto has tapped into this with SoFi's branding. That kind of goodwill is difficult to show on a balance sheet, especially when it's a long-term plan. Millennials are set to inherit up to 27 Ks worth of cash and assets from their parents and grandparents in the boomer and silent generations. This has been dubbed the Great Wealth Transfer and is a phenomenon that banks have been studying for some time. Millennials are typically comfortable with digital experiences, which SoFi provides and excels at over its peers. It is a digital brand, primarily based out of a smartphone app. There are no branches to go into, but it seems that millennials don't really mind that. Offering them an all-in-one app for their finances, with a positive mission that has positive associations with a beautiful sports stadium, and you've got a sales pitch that millennials seem to respond to very well, as we see the number of customers increases quarter over quarter. Risks, major. Risks that I have to mention include massive PE that could materialize into deep losses in a market crash, consistently negative ROE and FCF. The NFL contract for the stadium name is expensive and may not pay off. They may be outcompeted by larger institutions that adapt to millennial audiences as the great wealth transfer churns out new high-net-worth potential customers. Legacy financial firms may be able to keep these inheritors since the assets are already on the books at these establishments. And of course it's unprofitable, but it may not be forever. Conclusion: SoFi Technologies is an unprofitable finance company that is set to grow tremendously if you look at the trends in its revenue, free cash flow, and customer acquisition. It has also positioned itself well with its target audience, the inheritors of a large amount of wealth in the coming decades. Conservative investors are advised to stay away from this stock, as it is too volatile and risky for a conservative equities portfolio. Aggressive investors are advised to allocate no more than 4% of an equities portfolio towards SoFi and speculators could consider up to a 6% allocation. This is a stock that I am considering for my own equities portfolio and will be watching it closely. Thanks for reading.